So how can we move this 10 over so that it's in the center of our price? Well, one thing we can do is kind of play around a little bit with our calls. Our calls we had set at 155, which was just above the market. The current market for this ETF is 146. So let's see if we can go to the 150 calls and see what that does to our 10. Well, it does. It puts us a little bit closer to the center, and that's probably as good as we're going to get. In order to have a nice wide tent on this position, we want to have the difference between the calls and the puts to be at least $2.50 to $5. Now let's see what happens if we put these positions on at the exact same strike prices. And I'm talking about selling the puts on the front month at the same strike prices we're selling the calls on the front month. Let's see what happens to our 10. All of a sudden, our tent begins to look fairly not as wide at the top for sure. So we can take a look at the 145s and see if we can get closer to the center of this. And we're selling all of the 145s, but we're still a little bit off center, aren't we? And we don't have as much. We don't have a wide profit potential at the top of our graph. We're actually remember, this green line is what our profit potential is at the expiration of the front month option. So if we were to go all the way to expiration, that's exactly what this is exactly where our profit would be depending on the price. If the price was 141, our profit potential on this position for one contract is $175. If it settled right at 145, which is the center of our tent, which is the highest profit potential for this position, our maximum profit is $540. But this is not as attractive to me as our previous position. So let's take a look again at our 150 calls. We want to spread these out just a little bit. And now we've got a much wider profit potential, even though it may be a little bit lower, but I think it has a little bit more potential to be profitable because we have a wider range of price in here. So this is the profit picture that you really want to get. And the only way to get this profit picture is by playing with the option strike prices. Remember, we want to sell both a call and a put because we don't know which way the market is going to go. So we need to be, we need to keep our, since we're not predicting price, it doesn't matter if the market goes up, it doesn't matter if the market goes down. We want to be in the center of this profit potential position at all times. That's how we put on a double calendar. That's exactly what a double calendar is. It's the sale of a front month option. In this case, we're doing the Mays, and it's the purchase of the next month out, or possibly even 2 months out, of a call option at the exact same strike price. Now, to enter this order, all we have to do is right-click again in this green area and go up to Confirm and Send in order to enter this position. You can see that you have the order description up at the top. It's we're buying one contract, double diagonal, and it's actually a double calendar, but it's a double calendar is similar to a double diagonal. The only difference is the double calendar uses the front month and the back month strike prices are exactly the same. So we can enter this at a $5.79 limit. It does not give us our break-even maximum profit or maximum loss in this position because we're using 2 different months in order to put this position on. The cost of the trade for one contract is $579. There's $6 in commissions for a total cost of $585, which, by the way, is also the total maximum loss that you could have on this position. Since we use both puts and calls, though, the stock cannot be, in this case an ETF, can't be in the same, can't be up and down at the same time. It can only be trading at a single price. So one side of this position may be more profitable than the others, and normally if the trade does go against you, you can close it out with either a very small loss or maybe even a small profit without really harming your account. If we do keep it all the way to expiration, then all you have to do is take a look at the profit and loss graph to take a look at what your actual expiration profit potential is. So if you like the important thing here is to take a look at this profit picture and really like what you see. On this profit picture, you have a fairly wide break even, 141 on the downside, 155 on the upside. That's a 14-point spread between your high and low, and your current price is pretty close to the center. That's probably as close as we're going to get it. And so you've got a fairly wide margin of error here if the market goes up or if the market goes down. Like I said, though, it's very rare, and this is where the real secret of trading for monthly income comes in, and that is that you don't just put this position on, forget about it, let it go to expiration without taking a look at it at least 3, 4, 5 times a week, just for 10 or 15 minutes, and review the videos on portfolio management, especially to determine when you need to adjust these positions. Nobody's going to give you anything in the market. I mean, it's a given. Everybody is out for themselves, and that's the truth. They are not going to give you a profit on this position just because you decide to enter into the position. The truth is that the real profits come from adjustments when necessary. Remember, there's only two rules to the market. Rule number 1 is that prices will fluctuate. Rule number 2, as far as options go, is they will expire. And we take advantage of both of those absolute rules in the market because we have a wide price range that we're trying to profit from, and that takes, we are trading the first rule, which is prices will fluctuate. The second rule is options expire, and we're taking advantage of that because we are setting ourselves up for an expiration date in the future by using this green line as our profit target. And that's why these positions are really very powerful, because it takes advantage of the two biggest rules of the market. Now, if we were to enter this position, we've brought up our order confirmation dialog box. All we have to do is send it, and it goes off to the market, and we try to hopefully get our price. If we don't get our price, I show you in other videos when we actually enter into live trades exactly how to adjust your price in order to get filled on these positions. So take a look at those videos.